What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair. And for the next 30 minutes, every Saturday from 12:30 to 1 o'clock, we'll be taking financial chickens and making them financial swans. But what does it mean to be a financial swan? It means to sleep well at night. And I believe as a retiree, you've worked your entire life to get to this point. You put 3 kids through college. You found a way to invest in your 401k and even gave to your local church and your local charity. But it's time that you finally sleep well at night. And we're always seeking opportunities to share with you experts and making sure that you are highly educated, because we believe that education is key on a sound retirement. And so in just a few minutes, I'm going to bring on Dr. Rick Harper, who's an economist over at UWF. And before we do that, though, I want to share with you one opportunity so you can join the conversation with our website at swan-capital.com. That's swan, like the bird, -capital.com. And go on to our Get Educated tab. And what we've added recently was on our white paper section is a free white paper that you can download, and it's called Is College Worth It? And so it's a great white paper that we had written. And basically, it talks about all the statistics that if you have a child or a grandchild that's looking at going to college in the next 10 years or so, it's a good read for you to take a look at. So you can go to swan-capital.com to download that free white paper. Now, remember, the show is live, and you can call in the station anytime at 478-3116. That's 478-3116 to be able to ask your question about the economy today and peek into Dr. Rick Harper's crystal ball. So without further ado, Dr. Rick Harper, welcome to the show.
Thank you for inviting me in my crystal ball today, Andrew.
So we're going to start off with maybe a 10,000-foot view of the economy, and we'll swoop down to our local economy here in Escambia and Baldwin County. So let's start off with the major economy components like GDP. Are there some things that we need to know about GDP?
Well, gross domestic product, we had a really lousy first quarter in the U.S., down 2.9% in terms of inflation-adjusted gross domestic product. Second quarter, which of course just ended about 6 weeks ago, we're looking at that being substantially better. Most analysts are suggesting 2.5% to 3% GDP growth, but still, when you're trying to overcome a first quarter like the one we had nationally, remember all the bad weather events. It seemed like there was a snowstorm every weekend in Chicago and New York, and nobody could get to the stores. Well, it showed up in the data, just very weak economic performance. But since then, we've had some good data, actually. We just had the jobs release excuse me, I misspoke just a minute ago. Here it is, July. What is it today? The 10th. So we're actually 10 days into the third quarter, and we got the June job report out just a few days ago, and it was actually surprisingly strong, 288,000 net new jobs in the U.S. economy, and the Florida economy is also coming along. We've had good, strong job growth. We're among the national leaders. We're right up there with Texas. We're not quite at the North Dakota oil fracking-related job growth, but Florida's doing well, and Northwest Florida is coming along. Not as fast as, say, Orlando. Orlando's recovered all the jobs they lost in the Great Recession. We are about halfway back in terms of the number of jobs we lost here in Escambia County during the recession. But tourism and hospitality, so important to Baldwin County, important to Escambia, are growing as well.
You know, you mentioned sometimes Mother Earth is not as cooperative as we'd like it, right, Dr. Rick? But where are we seeing this GDP growth coming from?
That's a very good question from my perspective. You know, GDP growth comes from population growth. The U.S. population growth rate is about 1% per year, a little bit less than that, 0.9% per year.
Is that keeping up with what we're losing?
To get GDP growth up in the 2.5% to 3% range, we talk about the new normal. And in kind of a new normal economy, an economy that's recovering from the financial crisis, that's got a debt overhang as the government reduces its debt-financed spending, as households reduce their debt burden, which we're seeing on both counts. The federal government budget deficit is shrinking at a rapid rate, which means they're not spending so much, and so that contributes to lower GDP. They're no longer borrowing from our children at the rate that they were back in the depths of the recession.
Well, that's a relief.
Right, it is a relief, but what it means for today's economy is that the government is no longer shoveling purchasing power into the hands of state governments, into the hands of consumers, no more Social Security tax rebate for households. And so that's causing spending to be lower than the real 3% benchmark that we would expect. And so 2.5%, one out of those 2.5 comes from population growth. The other 1.5 is going to come from productivity growth. For a given size workforce, businesses are doing a good job at getting more output. And we all feel this. Most people feel like they're doing the jobs of 2 people, if not 3 people.
Sure.
And that's how you get productivity growth. So GDP growth is a little bit weaker than we'd like, but we are clearly in the middle of a recovery.
Now, I want to switch focus because I want to highlight a few concerns that I've seen as a wealth manager for my clients that I try to, bring this concern up to them so that make sure that we're properly protected. And if you're just tuning into What Your Money Would Say, I'm your host, Andrew McNair, and I have the pleasure of bringing on Dr. Rick Harper, and we're talking about the economy, talking about GDP growth. But I want to switch focus to a concern that I see. If you study, long history and trends, if we've had population growth, we had a huge baby boom back, 40 years ago now. And if they're starting to retire and they've been accumulating, they've been putting money into 401ks, IRAs, what is that going to mean over the next 20 or 30 years as they're retiring? They're sucking money out of the economy.
Well,
You think that would be a concern?
I'm a person that thinks that baby boomers working a longer time in order to finance their retirement, which they really haven't saved enough for yet. If you look at the bottom 25% of the income distribution in the United States, that bottom 25% of the income distribution actually has a net worth that is very small to even negative. How can you have a negative net worth? You can have more credit card debt and no assets.
Hard to retire.
It's impossible to retire in a situation like that. I mean,
now for the ones that saved and they have their 401k invested in the markets, and you see that some are pulling out to pay for the retirement to subsidize because pensions are a thing of the past these days, and they have Social Security. You think that might be an issue?
Well, asset markets are going to allocate people's financial capital, their savings, to the most efficient uses. This is increasingly for U.S. investors. The largest companies that make up the S&P 500 are gaining an increasing share of their profits from their overseas activities. They're selling to consumers around the globe. They're producing their goods and importing them back to the U.S., but they're making their profits that then contribute to the well-being of today's retirees who have, hopefully, a balanced portfolio that's appropriate for their age. U.S. residents who are savers, who are net savers instead of net borrowers, can take advantage of growth in the global economy because if you look at a company like Coca-Cola that makes the vast majority of its profits overseas, then if you own those shares, then you're really trusting in the executives of that company to pursue the best profit opportunities around the globe and earn a return on your money that's invested in those stocks. And, of course, you can buy stocks of companies that are based overseas. You can buy American Depository Receipts,
Absolutely.
ADRs, and be exposed to the international market. All in all, my takeaway from the economic environment and the savings environment is that this is a time when it's much better to be someone who, if you can arrange it, reaps the benefits from owning capital and earning the returns that come from a well-run company than it is to be someone who sells their labor into the marketplace. Wage earners are under increasing pressure. You and I were talking before the show about the effects of technology.
And automation.
Automation.
Computers are taking a lot of jobs, but we expected that with technology.
We did.
And
It's
advancements.
no different than what happened in the Industrial Revolution as people moved out of the fields into the factories. It's no different from the Agricultural Revolution, which really led to massive unemployment among horses, but it allowed people to go work at things where they're more productive. The Computer Revolution and Information Revolution is exactly the same sort of thing, but it's happening at such a pace that it's hard to retrain people who might have been employed, say they were construction workers in Florida. They lost their job during the downturn when the housing market collapsed. They're not immediately going to be able to turn around and become
an IT expert.
And so, yes, the job market has challenges.
And let's, before we wrap up about talking the macro trends of the economy, let's talk a little bit about the job market, because that should be somewhat of a concern with the automation. Is there anything you want to add to that about jobs?
Well, I think automation is a big concern, and so people who really want their kids to do well in tomorrow's job market, or who want to tune up their own skills, if you're going to be successful and earn high wages because you have scarce skills, businesses only pay high wages for things that are scarce and hard to obtain.
Specialized,
good information technology skills, good other skills, something that people that not many other people do. And so in an environment like that, you either have to be the person that designs that automated system, or that runs that automated system, or that owns the company that implements that automated system. It's a lousy time to be a worker who's in direct competition with whatever that automated system does.
Good point. If you're just tuning in to What Your Money Would Say, I'm the host, Andrew McNair, and I have the pleasure of having Dr. Rick Harper on, and we're talking about the economy. And you just tuned into a perfect time, because we're talking about job markets in the future, especially with all this automation. So I'm going to leave it up to Dr. Rick Harper to share with you what your grandchild or child should go into business. What industry?
Well,
the next 20 years.
The thing that's been creating all the jobs historically, we talk about eds and meds, that it's education and healthcare. Those are two industry sectors that have not been subject to the information revolution, although we're seeing the IT revolution now. Education.
University Phoenix?
Sure. Massively open online courses, MOOCs, as they're referred to in the trade. And that's revolutionizing the way that people can learn around the globe. And then you look at the healthcare sector, that's a lot slower to benefit from information technology. Imagine if your bank operated the same way that your doctor does. What if your bank said, I'm sorry, you're going to have to drive to the office and make your deposit to do business with us? Well, that's the way doctors' offices operate, and that's when you're doing something simple like picking up a prescription. And so we haven't yet seen, for a variety of reasons, the revolution in industry structure that will hit healthcare when information technology starts to be used in a more widespread fashion in healthcare.
Well, you've heard it yourself. Eds and meds, right?
Right.
Is what your children may be wanting to look into for the future, because the next 20 years could be bright in those sectors. So let's talk about equity markets. We've seen a fantastic growth, 29.6 in the S&P last year. We're up 5%, I believe, this year. What should you share? What should retirees know about the equity markets today?
Well, the Fed has worked very hard, the U.S. Federal Reserve System, and the Board of Governors in Washington, the policymakers on the Federal Open Market Committee, the FOMC, have worked very hard to ensure that interest-bearing assets are not attractive. Yields have been so low, we've pumped so much money, so much liquidity into the banking sector that essentially borrowing short-term dollars is free. And if borrowing short-term money is free, then a lot of the places where that money gets used then is that people borrow it and they put it into equity markets. And so my fear about the quantitative easing that the Fed has implemented is not so much inflation in consumer goods and consumer services. Although inflation has ticked up, it's been too low. We certainly don't want a deflationary spiral like we've had in Japan since the early 90s.
Exactly.
That's risky. But the Fed, in the course of trying to steer people into riskier assets, get them to make riskier investments, jumpstart the economy by jumpstarting companies with access to lower cost capital so they could do investment spending, up their productive capacity so that people would invest in riskier assets.
Couldn't that be a larger fear than inflation? Because if families that are very actually risk averse are being pushed to riskier investments, could that mean a big issue if we did have a market correction?
That's where I see the issue is in asset bubbles. I think that cheap money means that the Fed is encouraging families to put their money into assets which traditionally have been somewhat risky. But as long as there's an abundance of cheap dollars to borrow and then put into equity markets, then the equity markets go higher and higher. And so the risk is that as the Fed begins to withdraw its quantitative easing program, and we're expecting to see that probably, short-term interest rates should stay low into 2015, certainly. But as the Fed stops its bond buying program, the Fed's a huge buyer of mortgage-backed securities, keeping mortgage interest rates low so that people can purchase houses. But as the Fed withdraws that support from the market, then I would expect to see interest rates rise, and it's no longer going to be so attractive to borrow dollars and invest them in the stock market. That's when I would be fearful of a market correction in equities.
It's very interesting. If you've been listening to What Your Money Would Say, I'm your host, Andrew McNair, and we have Dr. Rick Harper, and we're talking about equity markets today and giving you an update into the third quarter. And he brought up something really interesting. Many families come to me that are worried about inflation rates and worried about the government printing more, and we're going to see huge inflation spikes we've seen in the 70s or 80s. I see those concerns, but we have a great economist sitting right here, and he says that's not the biggest issue you should be worried about. Is that instead people are going from typically risk-free investments and are going to risky investments like stocks and like bonds, which could potentially be asset bubbles like you mentioned. So with families that are going from CDs to bonds, sometimes they could act like, what I give the analogy is, they're throwing a Hail Mary on the 5-yard line, potentially.
Well, bonds as an asset class, if you're going to hold those bonds until they mature, then you're not really concerned with what happens to the market price of that particular bond as it's bought and sold out there in the secondary market. And so,
as long as you hold it for 20 years or 10 years,
if it's a 20-year bond or a 10-year bond, or hold it until it matures, then you get that return, that coupon off the bond. But certainly the value of the bond itself on longer term bonds, if you look at 20 and 30-year bonds, then they swing very substantially in response to interest rate changes. And so they're not a
And can you talk
asset.
about interest rates a little bit? Talk about the trend and potentially where we may be heading? Because I think that might be something interesting for bondholders today to know.
Well, what I see is that as the Fed stops the quantitative easing program and moves away from massive purchases of debt instruments and primarily mortgage-backed securities and treasuries, well, if the Fed's not going to be out there buying those bonds and driving their prices up, because when the Fed adds its demand to the market for bonds, that drives the price of bonds up.
Yeah, they're a big gorilla.
And they are the 800-pound gorilla in the bond market. They're the one entity that single-handedly can influence bond prices. And, of course, bond yields move inversely with prices. So as the price of a bond goes up, say that you're looking at a $1,000 10-year treasury, the more you have to pay for that $1,000 asset and its stream of coupons, then the more you pay, the lower is your effective yield on that asset. And so interest rates and bond prices move in the opposite direction.
Basically, for simple people like me, what you should know is the bond prices if interest rates go up, bond prices will go down, right?
Correct.
They have an inverse relationship. So if you're placing large amounts of your investment dollars in bonds, you could put yourself at risk if you think interest rates are rising. And some people don't know that relationship, right, Dr. Rick?
Well, that's certainly true among my students. That's one of the things we work on in macroeconomics. And so as the Fed stops its bond buying program, then that means that yields are headed upwards. And that's what you'd expect, to get savers to part with their money in the long term, to get them to lend it to somebody else so somebody else has use of it over a period of time. Historically, on an after inflation basis, lenders over a short period of time have needed to get 1% after inflation. Lenders on a medium term, 5, 7, 10 years, have needed to get 2% after inflation. And people who lend for a period of 30 years, which is what you do when you buy a 30-year bond, if you lend for 30 years, people have tended to need to get 3% after inflation. And we're still below those yields. And so when the Fed stops its bond buying program, I'd expect to see interest rates rise, and that's a healthy thing. I mean, it's a sign that the economy has moved beyond the financial crisis and its aftermath, and it's a sign that the economy's gotten healthier and stronger, but it's not going to feel good in the financial markets necessarily.
Especially if you're a bondholder today. Let's talk about a controversial topic all the time. It is the Affordable Care Act. We're starting to see some of the things being implemented. We're seeing some mandates pushed back. What do you feel like is going to be the effect over the next year?
The Affordable Care Act, commonly referred to as Obamacare, is a tough nut to crack. There's two things that need to happen in a wealthy economy like the U.S., but looking at the structure of U.S. healthcare, we've got to see two things. One is the insurance market expansion so that people have access to healthcare. That's what the Affordable Care Act was all about, and that's what it's done. But what ACA hasn't done is it hasn't reformed the health price system. And I like to use an analogy that my buddy Steve Jones taught me, which is the way that healthcare insurance works in the United States. Imagine if you had grocery store insurance. That's what healthcare insurance works like. So you went to Publix and you picked up your shopping buggy and you wheeled it around the store, but you knew that at the checkout counter, the checkout clerk was going to say, your copay today is $20. Well, that would mean that instead of picking up the bargain chicken at 99 cents a pound, you'd be picking up the filet mignon. It means that instead of the inexpensive drinks, you'd be buying French champagne because
you're buying it at a fractional piece.
Well, in the U.S. healthcare market, prices don't convey information. Hospitals don't know. They couldn't tell you if you came up to the door and said, I want to have my knee replaced a month from now. What's that going to cost? They don't have a price for that because they operate under a scheme where they get reimbursed for services done at a government fixed rate. And so until we break that logjam, until prices mean something, then we're not going to have the opportunity to reform cost inflation in healthcare. And if we don't bend the healthcare cost curve, if we don't decrease the rate of healthcare cost inflation, which, we've had some good inflation news in healthcare in the last year or so, but if we can't get it back down to at or below the general rate of inflation in the economy, then nothing else matters. Because when you look at the demographic makeup of the population, as you look at baby boomers going into retirement and going into Medicare age groups, then if we can't keep the cost of delivering healthcare services down, then that's what breaks the federal budget. And so it's all about entitlement reform. Those are the biggest spending components of the federal budget. Medicare, Medicaid, Social Security, they all make all the other government programs look easy. And so that's where we've got to go. But ACA didn't address cost reform in a meaningful fashion. Instead, it simply picked up, 30 million additional people with insurance and threw them at a healthcare market. And when you do that, when you throw an additional 30 million people at a healthcare market without increasing the supply of doctors and nurses and other practitioners, and without letting the free market work its kind of cost containment magic, then you're going to have higher healthcare prices. So to me, we haven't done the really necessary half of the equation with ACA. We haven't done healthcare cost reform.
Wow, and I love that. That's a beautiful analogy about the market of healthcare down to Publix. Makes me hungry though. It's around lunchtime, right? So let's jump into the micro trends. So let's talk about the local economy. We've been talking about the 10,000 foot level. So let's swoop down and talk about the Escambia County. What are some things that we need to know about?
Well, Escambia County is participating in growth. We've had some good job announcements recently. We had the offshore inland deep flex announcement just a few days ago for the port, 200 new jobs. To me, that's a potential growth sector. We should be investing heavily in servicing the offshore drilling and exploration fleet because Pensacola has a unique cost advantage for those operators because the port is so close to Pensacola Pass, unlike the facilities in Mobile Bay, unlike New Orleans, unlike even Port Fourchon in Louisiana. And also, as the federal government opened up drilling leases to the east as we approach even the border of the Eglin Gulf Coast Range, the military test range that's to the east of us. But as those drilling rights expanded, that puts those leasehold interests even closer to Pensacola. And if you're running a ship like the Global 1200, which is a multi-$100 million vessel, then you've got it budgeted to only be in port the minimum time possible. And so you'd like to have the shortest sail to your refitting facilities. Pensacola has a built-in competitive advantage. We ought to be investing there. Navy Federal doing great things on the north side of town. They are contributing as much job growth by themselves to the local economy as Escambia County would normally get in a year. And they're doing it every year. I mean,
wow.
That means we've got a nice high baseline to work from. Everything else is kind of like frosting on the cake. And so really, I think relative to years gone by, we're actually looking at a fairly good local economy for Escambia. And the real estate market is picking up. Baldwin is also looking at good economy.
I wanted to talk about that because, I just bought a house recently, looking at buying another one next week. With the inventory shrinking, we're going to see some trends in real estate market.
Well, with the available for sale inventory shrinking, Escambia, Santa Rosa, Baldwin, those are areas that are not seriously space constrained in the same way that San Francisco, New York, Miami are constrained on space for expansion. And so I don't think we have the same bubble potential. We don't have the same potential for real estate to earn long-term yields on a par with other asset classes, such as a well-managed and balanced portfolio of equities and fixed income, for example. So I don't think we're going to see that sort of bubble. I hope that we don't. I think housing here will continue to be affordable, contributes to our cost advantage. That's one of the reasons that manufacturing is looking more seriously at the Central Gulf Coast, from Pensacola over to Pascagoula, even New Orleans. Cheap energy prices, affordable housing. It's a great place to do business and raise a family.
Well, Dr. Rick, I really enjoyed your talk today. We talked about some really important things that investors should be aware of. One of them was GDP growth. We talked about the trends there that, we're making up for not bad GDP, but okay GDP earlier this year. We talked about interest rates, that they may rise over long term, which is a good trend to have, but it's something to be of interest for bondholders. We also talked about the local economy. We talked about jobs that are going into the market with the new port jobs. We're talking about Navy Federal. So if you want to recap the show, if you're just tuning in just late, go to Swan-Capital to check out the full show. Dr. Rick, thank you for coming on What Your Money Would Say.
Thanks for having me on today. Appreciate it.
Political issues in common sense terms. Phil Valentine, another exclusive on News Talk 1370 WCOA.